Good evening, friends. Input tax credit is a very important topic and chapter under the GST law. In this session, we will be dealing some of the practical aspects and case studies related to input tax credit, which is being faced by the taxpayers on daily basis. To start with, we will firstly discuss some of the fundamental concept of input tax credit, whether it is a concession or a right, eligible conditions for availing the ITC, and thereafter we will drill down into the case studies. Today, we will cover case studies related to sales promotion activities, ITC eligibility on construction of factories, ITC on employee-related transactions, payment to be made within 180 days, some of the intricacies involved in this proviso. Then we will discuss case studies related to Rule 4243, and we will see what is the tax treatment if I avail the ITC under the wrong head. Instead of IGST, I avail CGST, SGST, or vice versa. Friends, let us first discuss what is the nature of ITC, whether it is in the nature of concession or right. Right means something which you can demand from the government. You can state that I want ITC, it is my right, it has to be given to me. Friends, please note, it is a settled principle that input tax credit is a concession or a benefit which is given by the legislature to the taxpayers. And all this benefit can come with certain conditions which they can always incorporate in the legislature. On all these Supreme Court judgments, it has been held that it is in the nature of benefit and concession and can be received only as per the scheme of the statute. How much tax credit is to be given and under what circumstances is the domain of the legislature. So it is always a concession. In fact, if we can recall, in excise regime, excise was implemented in India since 1944. No SENVAT or no MODVAT benefit was given. MODVAT was introduced in India for the first time in 1986. Thereafter, the credit on capital goods was introduced for the first time in India in 1994. So SENVAT credit is or ITC is always a benefit which is given, and these benefit can come with certain conditions, and all these conditions can be divided into two parts. One is your substantive condition, second is your procedural condition. So this is the concept of ITC which we should always keep in mind. Once ITC is availed as after complying with the conditions, then it becomes your vested right. I repeat, giving ITC benefit to the taxpayer depends upon the legislature, and it can come with certain conditions. Once you satisfy those conditions, when you become eligible to avail the ITC, thereafter it becomes your vested right. Moving on, Section 16 of the CGST Act governs the provision related to input tax credit. Input tax credit on any goods and services are available if the same is used or intended to be used in the course or furtherance of business. Effectively, you will get the credit only if your specific goods or services which you are procuring is used or intended to be used in the course or furtherance of business. And friends, please note, when we say that my expenditure or the services or the goods which I am purchasing, it should be used for my business purpose, it has to be seen qua state wise and not pan wise. Let me give you an example. Say you are in Gurgaon, head office is in Gurgaon. Somebody from Gurgaon goes and travel to Maharashtra. In Maharashtra, he stays there for some head office work, and he stays in a hotel, and hotel gives the invoice in the name of Maharashtra registration number. You take the credit in Maharashtra, whereas your expenditure is booked in Gurgaon only. So Maharashtra would not be entitled to take the credit just because invoice is in the name of Maharashtra, whereas the expenditure is actually booked in Gurgaon state, Haryana state. So when we say it should be used in the business, it means should be used in the business of that particular state. Then you become eligible to avail the ITC. And this eligibility of ITC under Section 16 comes with various conditions. First condition, you should be in possession of a tax invoice. Now, e-invoice is applicable for taxpayers whose turnover is more than 5 crore rupees. So wherever your vendor is required to issue a tax invoice, e-invoice, you should make sure that they issue a e-invoice. Otherwise, the eligibility in my hand will be questioned. If they are required to issue an e-invoice, but they are not issuing and they're giving you a normal invoice, that will not be treated as a valid document for availing the credit. So please ensure you have proper e-invoice and obtain proper declaration from the vendors. Second, you have to ensure that in the invoices, all your particulars, the minimum required particulars are mentioned. So possession of a tax invoice or a debit note or a bill of entry is an important document for availing the credit. And recently, because of the implementation of e-invoice, we need to follow the invoice principle. Second is goods and services should be received. I am eligible to avail the credit only once the goods and services are received. The third condition is the details of the invoices or debit notes are furnished by the supplier in GSTR 1 and the same is getting auto-populated in GSTR 2B. Friends, after 1st January 2022, the law is amended. You will get the credit only if the invoices are uploaded by the supplier and the same gets auto-populated in your GSTR 2B. The law is clear as on date. Otherwise, the credit will not be eligible. Moving on, the fourth condition is supplier should have paid the tax to the government. It is not sufficient that the supplier has filed GSTR 1. In additionally, what you have to see is that they are also filing GSTR 3B. In fact, government has introduced Rule 37A, which says that if the supplier has not filed GSTR 3B by September of the following financial year, then the recipient is required to reverse the credit. And whenever supplier files 3B in future, then recipient can re-avail the credit. So you have to additionally check whether the supplier has filed GSTR 3B or not. The next condition is that the invoice should be paid within 180 days from the date of invoice. If you are not making payment to the vendor within 180 days from the date of invoice, credit has to be reversed and you can re-avail whenever you make payment to the vendor. This condition of making payment within 180 days is applicable only in case of a normal forward charge invoices. It is not applicable in case of import of services and nor applicable in case of reverse charge. And last, one of the most important condition is time limit within which you can take the credit. The time limit for taking the credit is 30th November following the end of the financial year to which the particular invoice or debit note pertains. So 30th November means that for financial year 2023, we can take the credit maximum up to October return, which has to be filed before 30th of November. So you have to make sure that you claim the credit pertaining to financial year 22-23 maximum by your October return, and the same has to be filed maximum by 30th of November. So it is not only claiming something in your October return, you have to also make sure that you record the said credit in your books of account before 31st of October. Very important. This credit entry has to be recorded in your books of account by 31st of October. That is also something which we have to adhere. And one important aspect to be noted with regard to this condition is that it is not applicable on import of goods. So this condition is not applicable on import of goods. There is no time limit applicable for availing credit in respect of bill of entries on import of goods. Similarly, in case of reverse charge, in case you are availing a reverse charge services from an unregistered vendor, this time limit is not applicable. Whereas if you are availing the services from a registered vendor, then this time limit will be applicable. So these are the basic principles and the conditions for availing the credit, which we have to keep in mind. Given this background, now we will move to our case studies. The first case study is ITC in respect of various sales promotion activities. Say I am organizing a foreign trip for my dealers on voluntary basis. I'm taking them to a foreign country. I'm receiving a tour operator bill from the vendor. Am I eligible to take the credit? What about credit of calendar, diaries, pen, crockery, poster item, hoardings, brochures, price list, which I circulate to the distributor and retailers? Am I eligible? What about credit under the target-based scheme? I come out with a scheme that purchase this much of quantity, get a fridge free, get a mobile free. Am I eligible to take credit? What about voluntary distribution of gold coins, etc. during Diwali season, etc. So there are various kinds of sale promotion activities which I incur, and department always scrutinize the eligibility of these credit. So let us understand whether I am eligible to take the credit or not. Friends, please note, there is no dispute and no one is questioning that these expenditure are not your business expenditure. Under section 16, you can claim credit of any goods and services which are used in the course of business. All these expenditures, whatever we are speaking, is used in the course of furtherance of business. So in spite of the fact that this is your sales promotion activity, this is used in the course of business, you are covered under section 16. That is not enough to avail the credit. What are the conditions? One is you should be covered under section 16. Thereafter, you should satisfy all the conditions which we just discussed, valid invoice, time limit, etc. And lastly, you should not be covered under the exclusion which is given under section 17.5. Section 17(5) carries various list of services and goods on which credit is not eligible, and government has within the legislature within their power, as what we discussed in the starting of the webinar, that it is a concession and this concession can come with a condition, and one of the condition is credit of section 17(5) is not eligible. So what you have to see is that am I covered under any of the exclusion clause under section 17(5), which covers the negative list of activities on which credit is not available. So the relevant entry for this purpose is 17(5)(h). Input tax credit in respect of goods lost, stolen, destroyed, written off, or disposed of by way of gift or free sample shall not be available. If I'm covered under this clause, in spite of the fact that this is activity related to my business, credit will not be available. The issue is, the entry reads, goods lost, stolen, destroyed, written off, or disposed of by way of gifts of free sample. And gift, what do you mean by gift? Gift is something which is given voluntarily without any attached consideration. So it is an act of giving something voluntary without any quid pro quo. Coming to our first case study, foreign trips. Am I eligible to claim the credit? It's a free gift given to the vendors, my distributors, my retailers, all big retailers, distributor. I'm taking them to a foreign tour. I will a tour operator service. Am I eligible to take the credit? The answer is the tour operator is raising an invoice. The invoice which tour operator raised is a service invoice. When we talk about this exclusion, what is excluded under the GST law is ITC in respect of goods lost, stolen, destroyed, written off, or disposed of by way of gift. If we see other entries under section 17(5), everywhere it says goods or services used for personal consumption, goods or services used for construction of immovable property. So there are various line items. Everywhere it is used goods and services, whereas under section 17(5)(h), what is used is only goods and not services. So if I am availing a tour operator service, I am availing an airline service, giving free tickets to my distributor, etc., I am eligible to take full input tax credit because it is an expenditure in the course of business, and I'm not covered under the exclusion under section 17(5)(h), as it is applicable only on goods and not on services. Though there are negative advance ruling, etc., but that is petitioner specific, and it does not lay down the correct picture of law and correct interpretation of law. According to our firm, we have a very good case to argue that credit on all these services are eligible. Moving on is the second set of expenditure which I incur. I generally distribute brochures, price list, diaries, pens, calendar, various items to my distributors. The issue is, am I eligible to claim the credit? We can divide this entire distribution marketing material into two parts. One is called material, which is a display material, which is a means of communication. For example, hoarding, brochure, price list, which does not have any economic value per se to the distributor. These are only your marketing material, your communication material, brochure, price list. So distribution of the same does not mean you're giving goods as free of cost, as gift to the distributor. We will not fall under this exclusion. Goods given as on gift basis, on free basis. These are your marketing material which you're giving to the distributor, and distributor does not have an economic value per se of these items. Accordingly, credit on brochures, price list, hoardings, etc. will be available. Whereas when I talk about other items, like you're giving some expensive pen, expensive diaries, digital diaries, etc., even though your name is printed on your pen, your name is printed on your diaries, etc., but these diaries pen can be independently used by the distributor. These diaries pens can be independently used by the distributors, and it has an economic value of its own. So it has a utility to the distributor, and the same will qualify as gift. So distribution of diaries pens will attract ITC reversal, whereas distribution of marketing material like brochure, price list, hoardings will not attract ITC reversal. There are multiple rulings. I'm not drilling down into each of the advanced rulings because there are some negative rulings, some positive rulings. What we are discussing in this session, considering that it is only a 1 hour session, concepts, when to avail the credit, when not to avail the credit as per the law. In fact, even if we see the UK rulings, etc., they have also specifically said that this point of sale materials, this point of sale material is something which is used in the course of business, display stand, posters, etc. So no reversal will be required in respect of point of sale materials. It's only something which has an economic value, like you give a gold coin, reversal required. You give diaries, reversal required. You give t-shirts, reversal required, but other materials not required. Moving on to the third is like target-based incentive schemes, wherein I give white goods to my dealers. I come out with a scheme. You purchase like a pharma industry. You purchase goods worth rupees 5 lakh rupees. You purchase medicine rupees 5 worth 5 lakh rupees. I will give you a white good, say a refrigerator free of cost. The issue is, am I eligible to claim credit? Can I say it is in the nature of gift given to the distributor? Friends, gift is something which is given voluntary. In fact, there is a circular and series of judgment which says, which is like one buy one get one free on interpretation of such kind of schemes. Circular, there is a circular in GST plus multiple judgments under pre-GST and GST advanced link, which says these are not in the nature of gift. See, ultimately, it is a marketing gimmick. Buy one, get one. You are charging price for both. It can be, so effectively you are supplying all the goods and getting a single consideration. So this is not something which is in the nature of gift. This is not given voluntary. The price is already factored in the price of the main product. Whenever I give a target-based incentive scheme, buy medicines of so much of quantity and buy medicines worth rupees 5 lakh, I will give you one white goods free. Effectively, that 5 lakh is a consideration for both medicine as well as white good, that is refrigerator. It is not given free of cost. And to my mind, since it is not free of cost, we will not fall under section 17(5)(h), and credit of the same should be available. But the real dispute is, if we argue that credit is available, we have to take a stand. This is not given free of cost, and it is not in the nature of gift, and the value, it is a effectively supply. I'm together supplying medicines as well as refrigerator and getting 5 lakh rupees as a single consideration. Then the issue is, will I fall under the ambit of mixed supply? Because I'm charging single amount of 5 lakh rupees and I'm selling both medicines as well as refrigerator. So effectively, it will amount to mixed supply. And since it's not a composite supply, accordingly, the highest rate it will be applicable. So whenever we are floating any target-based scheme, please remember, whenever we want to give certain free goods, give only those goods whose rate of tax is same as on the main product, or the rate of tax is lower, so that there is no tax exposure in respect of interpretation of mixed supply. Second, whenever we want to take an argument and we want to avail the credit, we have to make sure that all these target-based incentive schemes are floated in the market before the first supply. The distributor is very well aware that if this is the target they achieve, this they will get as a part of the target-based scheme. So all the communication and distribution of the scheme should be before the first supply. If all these conditions are satisfied, legally, I'm entitled to take the credit. Moving on to the next case study, ITC in respect of construction of factory. The company is engaged in manufacturing of goods and they are required to construct a new plant. Whenever a company is constructing a new factory or a plant, they will have to incur various kinds of expenditure. First is they have to procure land. It can be a freehold land or a leasehold land. Then is the civil work, construction of structure. Then you have various plant and machinery which has to be incorporated, like lifts, HVAC, and other plant and machineries. Then we have movable items called computer and furniture. So this is the bucket under which your entire construction journey can be divided. Section 17(5)(c) and 17(5)(d) is the relevant section which says works contract credit on works contract services as well as goods or services which are used for construction of immovable property will not be available except if it is a plant and machinery, or it is a movable item, or it is used for further supply of works contract services. So effectively, credit is not eligible on works contract services or any other goods and services which you procure for construction of an immovable property for own use. What are the exclusion? If it is a plant and machinery, restriction is not applicable. If any goods and services which is procured is movable, it is not forming part of immovable property, restriction is not applicable. So we have to keep in mind these exclusions. Basis this, let us now understand the taxability in respect of various expenditure which I incur during the construction stage. First is, like if I procure a freehold land, no issues. But if I'm procuring a leasehold land, I pay GST on the lease rentals, lease premium. The first issue is I procured a leasehold land for 99 years and I paid 18% GST on the leasehold premium, being a commercial property and being not a residential. Am I eligible to claim the credit of this GST paid in respect of procurement of leasehold land? To my mind, it is a very good case to argue that procurement of leasehold land is not a services or goods which are procured for construction of immovable property. It is not an expenditure incurred for construction of immovable property. It is an amount which is paid before starting of construction. It is before the construction will take place. So it is not for construction of immovable property, but a step before construction. It's a pre-construction activity, and accordingly, it should not be covered under section 17(5)(c) and D. However, department generally dispute at ground level, but to our mind, it is a very good case to argue. Moving on is with regard to the expenditure incurred on interiors and construction, civil work, all your structure which you make. No credit available, straightforward, you are covered under section 17(5)(c) and D. One of the dispute which we are facing these days is like many of the people are now is not the traditional construction style using bricks and cement, etc. Step-by-step construction. What these days people are building is a prefabricated building. They get prefabricated structure, they build it, and effectively, technically, it is also possible that this prefabricated building can be dismantled and moved. Technically, there is a possibility. The issue is, if I'm constructing it using prefabricated material, can I get the credit? Friends, this issue itself is disputable. See, what is an immovable property is a matter of interpretation. One position is that immovable property is something wherein I cannot shift it to another place. If I shift, it has to be dismantled and it will cause substantial damage. In such a situation, only a structure which can be shifted without causing substantial damage can only qualify as a movable property. If there is a substantial damage, it will qualify as an immovable property. This is one test. Second test is, even though technically it is possible to shift something, but the intention is not to actually shift. The intention is to make it permanent there for the benefit of the land. For example, this second principle, that is intention-based principle, that technically though it is possible to shift the material or a structure, but it is not intended to be shifted. It is always intended to be stayed there for the benefit, enjoyment of the land. For example, this second principle is pending before Supreme Court in respect of towers. Towers technically may be shifted, but still it is always there for the beneficial enjoyment of that particular location on which it is constructed. So this intention-based principle is still pending before Supreme Court. So same theory which is applicable on towers can still be applicable on prefabricated buildings, wherein we can argue technically prefabricated building is capable of being moved and dismantled without any substantial damage, and hence it should not be an immovable property. But the real test is, even though technically it is possible, but what about the intention principle? My intention is never to move them. So it is a disputable area, and we await the decision of the Supreme Court in respect of tower, which will be helpful in analyzing the implication of prefabricated building also. In the meanwhile, what we suggest to the client is avail credit and reverse the same under protest, so that in future, whenever there is a favorable judgment, you can re-avail the credit. Moving on to the plant and machinery, any lifts, HVAC system, any plant and machinery, firefighting system, DG set, credit electrical items, all credit of all these items will be available because these are covered under plant and machinery. Similarly, credit on all your movable items will be available, say furniture, projectors, lights, etc. Even in fact, when I talk about foundation, plant and machinery, foundation and structure, credit of the same is also available. So effectively, what we have to keep in mind is that whenever we are constructing a factory, we have to make sure I give separate contracts and have separate invoices for items on which credit is available and for items on which credit is not available. For example, you are procuring cement. You may use cement for construction of a building, and you can use cement for as a foundation of your plant and machinery. For foundation, it is available. For construction of building, it is not available. So I have bifurcated invoice or have an engineering report stating that this much of cement is consumed here, this much of cement is consumed there. So always try to bifurcate your procurements from the PO level itself. Wherever credit is available, best policy is to have separate agreement, separate PO, separate invoice, so that there is no dispute at the ground level. Now, moving on to the next topic, ITC on IPO expenses. Is one of the hot topic these days. TGI Gurgaon has raised issues to almost all the companies who have done the listing, and they are of the view that any expenditure which you have incurred for IPO, initial public offer, credit is not available because this is a transaction in securities. You are issuing a fresh shares for which you are getting money. So it is a transaction in securities, and any credit pertaining to such activity. Say you pay GST to your brokers, you pay GST to merchant bankers, various advisors, various advertisement, marketing material, processing fee. So many expenditure is incurred, and there is a good amount of GST which is involved. They are of the view no credit is available. So let us see, and like many of the companies have issued notices also. Friends, credit is available if my expenditure is in the course or furtherance of business. So let me see, whenever I'm getting an IPO and incurring various expenditure for IPO, is these expenditure incurred for the purpose of my business? The answer is yes, because ultimately, whenever I come with an IPO, I get fund. It is a mode of financing. I get funds, and that funds I deploy it in my business. Effectively, whenever you file your DRHRP also, you write the purpose of IPO, where the funds will be deployed. So if we see those purposes, the fund is either used for some expansion activity, for repayment of loan, everything related to business. So effectively, all these expenditures of IPO is nothing but incurred in the course of furtherance of business, because IPO results into a financing activity which helps you in business. So you are directly covered under section 16. The real issue is that whether I am covered under section 17 and say that this is a transaction in securities. As per section 17, transaction in securities is treated as an exempt turnover, as an exempt supply, and any expenditure incurred for transaction in securities is not eligible. Friends, to my mind, the phrase transaction in securities, this phrase was earlier there in pre-GST regime also, wherein the word was trading in securities. So in pre-GST regime, trading in securities was treated as an exempt service. Now in GST, transaction in securities is treated as an exempt service. So transaction, to my mind, though transaction is a wide word, but effectively the intent of this proviso, this provision, is to cover transactions of purchase and sale of security. Issuance of a fresh equity IPO is a financing activity, and to my mind, it should not be treated as a transaction in securities. Transaction in securities should be limited to purchase and sale of shares. You cannot link an IPO with normal purchase and sale of share activity, which generally a corporate undertakes. Hence, it should not be covered under section 17(2), and it is practically a very good case to argue that I'm not required to reverse the credit. Moving on to the next case study, ITC availed under the wrong head. Practically what happens is that, let me take a case study. The first case study is, I was supposed to avail IGST credit. Instead of IGST, I wrongly availed CGST and SGST credit. What should I do? First, if this entire mistake which you have done, you are able to find out within the time limit of 30th November, the best way is take the correct credit of IGST and pay CGST and SGST which you have wrongly availed. So take correct credit and pay the wrongly credit which you have availed. That is the best practice. But what if you come to know about this dispute and this mistake after the period of 30th November, wherein the rectification process is over? You cannot further avail the credit. In this situation, to my mind, one of the arguments which we can undertake is that this is a revenue neutral situation. See how it is a revenue neutral situation. I was supposed to take IGST credit. IGST credit I could have used for payment of IGST as well as CGST as well as SGST. But instead, what I have done is I have taken CGST and SGST credit. Instead of taking IGST credit, I took CGST and SGST credit. Since I took CGST and SGST credit, my utilization also become limited, because CGST credit can be used for CGST or IGST and not for SGST. Similarly, SGST credit cannot be used for payment of CGST. So my utilization is limited. So effectively, you can take a legal argument that by taking wrong credit in the form of CGST and SGST instead of IGST, there is no revenue loss to the government. Since there is no revenue loss to the government, there should not be any implication in the hands of the taxpayers. Friends, when we talk about output tax, output we have section 17(7), which is clear that if you pay wrongly CGST, SGST instead of IGST or vice versa, pay the correct tax and take refund of the wrong tax paid. But under GST, if in respect of ITC, if I make this mistake while availing the credit, there is no specific provision. So to my mind, if it is not beyond the time period, in that case, revenue neutrality can be one of the biggest ground to fight. And this is the ground which we are actually taking at various adjudication level to fight the case. When we talk about the second case, I was supposed to take CGST SGST credit. Instead of taking CGST SGST credit, I took IGST credit. Friends, in that situation, it is not a revenue neutral situation, please note. You were supposed to take CGST and SGST credit. CGST SGST credit can be utilized in a limited manner. Instead, you took IGST credit whose utilization is more than the way CGST and SGST credit can be utilized. So this is not exactly a total revenue neutral situation as the way we discussed in the first case. So in this case, revenue neutrality will not be a strong ground. So practically what we generally advise is that pay the correct, whatever you have wrongly availed, reverse it and take the credit of the right under the right head. So take CGST and SGST credit and pay back the IGST credit. The issue will be I am taking the CGST and SGST credit after the time limit of 30th November, wherein we can argue that this time limit should not be applicable when I had initially taken the credit on the basis of the same document. So I just took the wrong credit, but I took the credit basis the same document. Now I'm taking the revised credit. So this time period should be applicable only in respect of first time credit and not in case of recredit. So that is an argument which is available. We have Aurobindo Forma judgment under tribunal and excise circulars, etc. We say that time limit is not applicable in case of recredit. So based on that principles, we can argue that even after 30th November, we can rectify and take the credit based on the fact that time limit is not applicable. Now moving on to our next case study, a very important case study. How to deal with the situation. Like this is one of the specific condition under the GST law, which says that you can avail the input tax credit provided you pay the amount to the vendor within 180 days of the date of invoice. If you don't pay the amount within 180 days of the date of invoice, you have to reverse the credit. So this is section 16(2). Then we have rule 37. Rule 37 was substituted with effect from October 2022. So before 1st October 2022, the rule was different. After 1st October 2022, the rule is different. So let us discuss the gray areas which we are facing. Firstly, let me talk about the period from 1st July 2017 till 30th September 2022. During that period, we are receiving a lot of notices during assessment, audit, etc. that if you have not paid the payment within 180 days, please reverse the credit. So the real issue is, what are the grounds available to me to fight the case during the assessment and audit proceeding in respect of such issue which is raised by the department? Friends, please note, the way Rule 37 was drafted before September 2022, it stated that if you don't make the payment within 180 days, just see the highlighted part. I need to submit the details of such ITC which I have not made payment within 180 days in GSTR2 format. And after furnishing the detail in GSTR2 format, the same would have been added to my output tax liability and I should have paid the amount. So this was the procedure which was prescribed for the purpose of demanding the amount of ITC in case I have not made payment within 180 days. The way Rule 37 was drafted, it was based on my earlier GSTR 1, 2, 3 principles. My GSTR 2 never got implemented. So I have a legal argument to say that my entire Rule 37 was based on GSTR 2 and GSTR 2 never came into picture. So there was no mechanism to reverse the credit, no mechanism. Even in 3B, there was no specific table to give the details of such reversal, etc. Accordingly, the way rule was drafted, it was based on my reversal should be based on GSTR 2 mechanism. And since GSTR 2 mechanism was not implemented, I am not required to reverse the credit. So that is the legal argument available for the past period. So what we generally suggest to the client is that at least for the past period, sometimes under pressure, we may have to reverse the credit. Or what happen is that I generally don't make the payment after 180 days, but I have made the payment after 365 days, after 450 days. Down the line, 1 year, 2 year, 3 years, I have made the payment. The department demands interest. So you can always argue and say that Rule 37 should not be applicable based on the fact that GST 2 was never implemented, hence no interest payable. So for the period from 1st July 2017 till 30th October 2022, it is a good case to argue that interest is not payable. However, post amendment after 1st October 2022, they have done away with all these loopholes. Now, what they have said is that you have to reverse the input tax credit availed in respect of the supply in GSTR 3B. Now, they have specifically amended the mistake which they were carrying in the log. And please note, very important, this amendment is prospective and not retrospective. It is substituted with effect from 1st October 2022. So that is very important to note that this is a prospective amendment and not a retrospective amendment. Since it is a prospective amendment, effectively, it gives us more strength to argue for the period prior to 1st October 2022 that there was no need for reversal, there was no need to pay interest. Now, after 1st October, I cannot take this stand. The law has been rectified. If payment not made within 180 days, I have to reverse the credit. But the real issue arises, how about the interest? Friends, if we see the rule prior to 1st October 2022, please read it carefully, very important. Earlier rule 37 said that I am supposed to pay interest starting from the date of availing the credit. So even if you have not paid payment within 180 days, from the first day, the interest levy was there. The first day of availing the credit, the rule said you have to calculate the interest from that time. Now, rule 37 has been omitted. So the issue is, what is the current situation? From which date the interest will be applicable? If I don't make the payment within 180 days, I will reverse the credit. Am I required to pay interest? Is it from the date of availment? Is it from the completion of 180 days? Or is it from the date of utilization? Friends, there is no question of levying interest from the date of availment. Because when I availed, interest is always leviable under section 50. It is if it is a wrongly availed input tax credit and utilized. Wrongly availed and utilized is the word used under section 50. Section 50 is the governing section to levy interest under the GST law, and it says interest is leviable only in respect of ITC wrongly availed and utilized. So when I took the credit initially based on that invoice, it was not a wrong credit. Since it was not a wrong credit, the question of levying the interest from date of availment does not arise. Then moving on, what about should I pay the interest after 180 days? Ideally, if you have not paid payment within 180 days, my interest meter start after 180 days, subject to the condition that this ITC is utilized. See, effectively, interest can be levied only in respect of ITC which is utilized. So if you have a balance, accumulated balance, even after 180 days, and you have not utilized the ITC, still interest will not be applicable. You need to merely reverse the credit, interest not applicable. So effectively, interest should be levied to our view either from the completion of 180 days or from the date of utilization, whichever is later. I repeat, interest should be levied from the completion of 180 days or from the date of utilization, whichever is later. The last issue which we generally face in respect of such provision is that many a times I get a purchase order, like I'm purchasing a very big machine. My machine is itself worth say 50 crore rupees. I have to make payment down the line 1 year, 1.5 years. But when the vendor supplies the machine, they will raise a single invoice of 50 crore rupees, but I have to make payment down the line 1 year, 1.5 years. On all big manufacturing plants, my payment terms is staggered. Can department come and argue that credit should be reversed because you have not made the entire payment within 180 days? To my mind, if it is contractually agreed between the vendor and the manufacturer that my payment terms is so and so, then there is no failure on my part to, because when is this particular section triggered? Section 16.2 is triggered when recipient fails to pay tax to the supplier. When they fails to make payment, fail means there should be an obligation to pay, and then there is a failure. When my purchase order itself said that I will make payment down the line 1 year, my payment will be staggered for 1 year, then there is no failure on my part. So we can argue that in all big procurements of your plant and machinery, etc., where payment has to be made over a period of time, there is no failure on your part. All your terms were agreed ab initio, and hence there should not be any reversal. But all these propositions are yet to be tested in court of law. At ground level, friends, department will not accept it. They will ask for proportionate reversal, and they will say, please reavail whenever you make the payment. All these propositions has to be tested at higher forums only. Moving on to Rule 4243 case study. Friends, whatever ITC we are availing, if I'm engaged in providing a taxable supply of goods and services as well as exempt supply of goods and services, then whatever ITC I'm availing, I need to bifurcate into 3 parts. One is an ITC, which is used for providing and taxable services or taxable goods. Second is ITC in respect of goods and services which are used exclusively for exempt turnover. Third is which is used commonly. So no ITC available in respect of goods and services which is used exclusively for exempt turnover. In respect of common credit, you have to avail the proportionate credit based on the turnover ratio. Under GST, we have the concept of turnover ratio, whether it is procurement of goods, whether it is procurement of services, whatever is your common credit, you can procure based on the turnover ratio, that is taxable turnover upon total turnover. So credit used exclusively for taxable turnover, full credit available. Goods and services used exclusively for exempted turnover, no credit available. In respect of common, only proportionate credit is available. That is the law. Now, what are the practical issues which we generally face? One is like, what will be counted in exempt turnover? Interest? No, interest is not an exempt turnover. There is a specific exclusion under the ITC law. Interest will not be treated as an exempt turnover for the purpose of ITC reversal. Trading in securities? Yes. Trading in securities, 1% of the sale turnover is treated as exempt turnover, and any common services related to trading in securities, you need to reverse the credit, but you need to identify what is common to trading in securities. Every service is not common. You need to actually check which service is actually common to trading in securities. Dividend, can I say dividend is an exempt turnover? I need to reverse common credit. Dividend is not an exempt turnover. Please note, it is not an exempt consideration for an exempt supply. Effectively, it is not a consideration for any supply. It is only arising out of the ownership of the shares which you are holding in the other company, by virtue of which you are receiving a dividend. There are European Court of Justice judgments which says that it is not a consideration for any exempt supply. Hence, there is no requirement of reversal in respect of dividends, etc. Friends, so my entire GST law, my common reversals is based on the turnover of my exempted product or exempted services, except in case of real estate. In case of real estate, my reversal has to be undertaken based on the area. Whenever I receive an OC, today there is a project which was started in pre-GST regime. Today I receive an OC, I have to reverse credit based on whatever credit I have availed in GST regime. I need to divide it based on the area unsold upon total area of the project. So in case of real estate, my reversals of common credit is based on the area unsold upon total area. And in respect of all other industries, my reversal is based on the turnover only. Practically, whenever there can be multiple case studies within this rule 4243. And let me take example of restaurant. In restaurant, say it is in a 5-star restaurant wherein restaurant is charging 18%. But that restaurant is also serving liquor. Liquor is not chargeable to GST. That is exempt supply. So that restaurant is giving a taxable supply as well as exempt supply. How to determine which is used exclusively for taxable supply, that is restaurant, which is used exclusively for exempt supply, that is liquor, which is used commonly. I have singers singing there. I pay them professional fee. GST bills comes. I have professional chef, manpower supply. I pay GST. I use cutleries. I use glasses. I use AC, foundation. There are so many crockeries, furnitures. So we need to actually identify which is exclusive to restaurant, which is exclusive to liquor, which is common to both. So this is an exercise which has to be taken based on case-to-case basis. Now let us move on to our next case study, which will be taken by Nitika. Over to you, Nitika. I'm also giving you the remote control.
Sure, sir. Thank you. Yes. So now next case study is for the employee benefit. There are number of expenses incurred by employees to on its employees, by employer to on its employees in the regular course of action. So we will take few of the examples such as food and beverages, hotel and travel, and uniform, gloves, laptop, etc. provided to the employees. First of all, let's understand what are the provisions, what are the specific clauses which restrict ITC in case of goods and services provided to the employer and employees. So in this case, section 17, yes, ITC clause I, which restrict ITC on food and beverages, outdoor catering, health services, life insurance, and health insurance. Clause G, restrict ITC on goods and services used for personal consumption. And then we have clause H, which restrict ITC disposed of by way of gift or sample. In case of uniform, gloves, helmets, safety and office laptops, it cannot be said that these goods are given as a gift, and these goods are basically used in the during the employment and during the office premises only, and therefore this cannot be treated as a gift. And these goods are also not excluded under section 17(5)(g), which is exclusion is on account of personal consumption, and personal consumption is for the taxpayer and not for the employees. So in our view, the ITC on such goods provided to employees will be eligible. In next case, we have hotel and travel expenses. ITC on business travel is allowed. ITC available on airfare, railway fare, provided you have valid invoice. We have observed many taxpayers who are getting the invoices reflecting in their 2A, but do not have proper invoices in such case. So in this case, you have to ensure that you have proper invoices with you to claim such ITC. In case of hotel bills, ITC is available on room charges, provided that you have proper invoice, and then you are claiming the ITC in the state where the services are actually consumed. For example, if my employee from Goa, from you can say Gurgaon location, head office, which is in Haryana location, is moving to the Gujarat, and there he stay in a hotel. So I asked the hotel service provider to give me a invoice on the Gujarat GST only, so that I can claim the ITC. But in this case, I will book the expense in the accounts of Haryana location only. So my ITC should be eligible in the case of Haryana GST only, and not to the Gujarat GST. So these are the things which we have to take consideration while taking ITC on room charges or hotel bills. For food, we do not have ITC. We cannot take ITC as it is disallowed or ineligible under section 17(5). Next, we have canteen services. In canteen services, we can broadly bifurcate the services in two categories. First, when we are supplying services, canteen services free of cost to the employees. In this case, this will not be treated as a supply of services, as it will be out of GST purview under Schedule 3. And ITC is not available on such food and beverages in terms of section 17(5), provided it is not mandatory under any other statute, which means that in case of factory where it is obligatory to the employer to provide such meals to its employees in the factory, then ITC will be eligible. In case I'm receiving some recovery from the employees, and therefore I'm giving the canteen services at a subsidized rate, in that case, the amount which I am recovering from my employees, that will be considered as a supply of services, and ITC will not be eligible. It may be noted that tax on such transaction would be 5%, and because of the restriction in the rate notification of the basically 5% is a concessional rate, so ITC will not be eligible in such case. We have various rulings also which state that ITC, that GST should not be payable at the recovery amount which we made from the employees. But to our understanding, the grounds which they have taken are not sound enough to litigate to lower authority, to fight at the lower authority, and therefore we in our opinion, the transaction and the recovery so made by the employees should be taxed at the 5%. Also, the rulings also state that ITC should be taken or should be can be claimed at the proportionate amount in the hand of taxpayer. Next, we have hiring of motor vehicles. In such case, as per section 17(5)(a), motor vehicles for transportation of persons having approved sitting capacity of more than 13 persons, including driver, is basically is not allowed. More than 13% capacity, ITC is allowed. Less than 13 capacity, ITC is not allowed. So in such case, if you are providing services of say rent a cab services to your employees, ITC will not be allowed. And in case you are providing bus services, you are providing bus to the employees, ITC will be eligible. In the next topic, we have departmental notices for difference between 2A and 3B. There are different assessment and audits under GST, and in each of these scrutiny notices we are generally receiving, or each of the audits we are getting, there is a one common query, which is ITC difference as per 2A and 3B. To analyze this topic, we can bifurcate the period in three categories particularly. First one is 1st July 2017 to 8th October 2019, where there was no specific section which obliged me, which claimed me, compelled me to take the ITC in accordance with my reconciliation and to do the GST 2A reconciliation. Then after 9th October, or you can say with effect from 9th October 2019 up to the date of 31st December 2021, the government introduced a particular rule, which is Rule 36(4), which compelled me to do reconciliation as per 2A, and which allowed me ITC in excess of my ITC reflecting in my 2A up to a certain percentage, which was earlier 20%, then reduced to 10%, and then 5%, and then it was same as the 2A only. In both the scenario, because the 36(4) did not have any legal support, and it had no legal backend or corresponding section under GST Act. So for the both particular category of the time, the issue was disputed and was challengeable. So the government made a clarity from the circular which they issued in December 2020 to circular number 183, where they relaxed and where they provide relaxation to the recipient, and they said that ITC will be allowed even if the same is not reflecting in your 2A, provided the tax has been paid by the supplier. For this, they provided you some condition that this may be the cases where ITC may not reflected in your 2A, but the taxpayer might have paid the taxes. So the onus was put to the recipient to prove this, and they say that if the amount of the difference is 5 lakh rupees for a registered person for a supplier in a financial year, then you can take, if it is more than 5 lakh, you can take CA certificate, and if it up to 5 lakh, then you can take supplier declaration, and then you can claim the ITC. But this circular, which I referred earlier, which I mentioned earlier, was particularly applicable for 17-18 and 18-19. So again, the dispute continued for the period 1920 up to the period of 31st December 2021. In this case, the department again issued a circular, which was circular number 193, which says that the benefit of circular 183 will be continued for the rest of the period as well. And in that case, you can claim the ITC even if it is not reflecting your 2A, provided you have provided Rule 36(4) is compliant. So it particularly mentioned a rider in the circular. To analyze this, basically we have the illustration here that suppose in this case I have ITC of 5 lakh rupees which I have claimed in 3B, and only 3 lakh rupees ITC is reflecting in my GSTR 2A. So as per the Rule 36(4), the relaxation was earlier 20%, 10%, and then in third case 5%. Relaxed ITC will be 3 lakh for 20,000, will be 60,000, 30,000, and then 15,000 for the next period in all the cases. So how much relaxation I can get from the circular 193? Circular 193 is restricting my ITC up to the Rule 36(4). So as per circular 183, which was issued for the financial year 17-18 and 18-19, I could take the ITC of 2 lakh rupees, which was not reflecting in my 2A, basis the CA certification or supplier declaration. But here in reference to circular 193, now I can take ITC up to the 36(4) only, which is 3,60,000 is first case, 3,30,000 in second case, and 3,15,000 in next case. So the circular says that even if you provide me the CS certification or supplier declaration for the total differential amount, which is 2 lakhs in first key, in all our cases, I will be giving you benefit up to the ITC allowed in terms of Rule 36(4). So the benefit will be restricted accordingly. In for the next one, for the next period, which is my period of 1st January 2022 onwards, the government particularly inserted a clause under section 16(2), which is clause AA, which is stated that ITC will be allowed to the recipient only if the same has been communicated by the supplier in its GSTR1 and the same is reflecting in GSTR2B of the recipient. And also the corresponding changes was made in Rule 36(4). So after that period, there was no confusion, there is no litigation, and everyone was doing the reconciliation. But for the initial period of 1st July 2017 to 31st December 2021, there is no such legal supportive, and the Rule 36(4), as I told, do not have a corresponding section, so that was challengeable.
Thank you, Nitika.
Thank you.
Effectively, after 1st January 2022, you have to follow GSTR2B, credit available only if it comes in GSTR2B. But before that period, legally, there was no section under section 16. There was no clause under section 16. You can argue, fight in court of law, and there is a very good chance to win the case at higher forum. But if you want to get the relief at the lower forum, you have to follow the circular. To the extent you are able to comply the circular, you will get relief at the lower forum. For the remaining amount, before 1st January 2022, you have to go to the higher forum. With this, we end our presentation, and now we will be taking up the question and answers. Now, coming to question and answers, the first question is whether the tax invoice should be physically signed or digitally signed. See, there can be 3 types of invoices. One is an e-invoice. If you have e-invoice, there is no need for signature. That is sufficient enough. Second is there is a manual invoice. If you have a manual invoice, it has to be physically signed. Third is a soft invoice, but that should be digitally signed. If a soft copy is coming, that should be a digitally signed invoice. Physical copy coming, that should be manually signed, or they should be an e-invoice. The next question is purchases of import made in 2017. Can I avail the credit in 2023? Yes, if you have made the imports in 2017, you have not availed the input tax credit, then the credit of the same can be availed in 2023 also. There is no restriction to avail the credit in 2023. What we discussed during the presentation also, the time limit for availing the credit does not apply in case of import of goods, and hence credit can be availed now also. But since you have not availed the credit during that period, you must have factored the same in your books of account as an expenditure or as a part of your purchase price. So effectively, you have to rework that entries, but credit can be availed in 2023. Can we take ITC of electricity bill paid as the Board of Electricity is charging GST in its bill? See, GST is not being charged on the supply of electricity. It must be some incidental services related to that. These expenditure are in the course of business, and credit should be availed. Correct credit not availed before 30th November. Can we reverse the credit in books and it can be availed in subsequent year? See, this is a question that can I avail the credit in before 30th November, reverse it, and then avail it at subsequent period of time. We can do it. See, the time limit for availing the credit is not applicable in case of recredit. It is applicable only in case of original credit. So originally, if you avail the credit, then you reverse it and you want to subsequent claim it, you can do it. But we always request our clients to give an intimation to the department that this was the credit which you have availed in your GSTR2B and this you have reversed under protect so and so forth, and you have the right to reclaim in future. So that communication to the department is very useful for undertaking this exercise. For payment not made within 180 days, is interest still waivable if not reversed under 180 days if the credit is not utilized? I have availed the credit, not utilized. Am I still required to pay interest? See, friends, interest is waivable under section 50, which says that ITC wrongly availed and utilized. The word is availed and utilized. Now you have availed the credit on an invoice. You have not made payment within 180 days, but you have not utilized the credit. It is still availed but not utilized. So there is no liability to pay the interest because ultimately interest flows from the substantial section, which is section 50. Rule per se cannot levy interest. Interest has to be levied as per the act. We have Supreme Court judgment in the case of Indian Carbons, JK Synthetic, that interest provision is a substantive provision which has to be complied with. Accordingly, if you have not utilized the ITC, no interest can be leviable in any situation under the GST Act. Can we avail IGST on bill of entry pertaining to the year 2021 in 2023? Yes, it can be availed. The time limit is not applicable in such cases. Can I get input if branch transfer was not intended initially, but later on I need to branch transfer material other than space? My output is exempted. See, you procured certain materials. You thought that this material will be used in my own branch. And since my branch is giving an output service, you did not avail the credit. Now you want to transfer that material to some other branch, so there will be an output supply. It happens in various industries like power industries, oil and gas industries. Such situation happens. In that situation, you can claim the credit provided it can be claimed within the time limit of section 16.4. Please note that the time limit of section 16.4 is not a procedural condition, but a substantial condition. In fact, recently the Andhra Pradesh High Court said ITC is a concession, and this concession comes with one of the conditions, which is time limit. And this time limit accordingly has to be complied with. So you can still avail the credit if you transfer it as it is to the other branch by treating that as an output supply and availing the credit corresponding to this output supply, but everything has to be within the time period for availing the credit. If ITC is paid under reverse charge in pursuance of an audit proceeding under section 65 and under section 73, whether we can claim the credit? Yes, ITC can be availed in respect of RCM paid and during the audit proceeding or under section 73. What is restricted under the GST law is taxes paid during proceeding under section 74 and 129 and 130. So if you are paid under 65 or 73, you can avail the credit. But please note, many times what happened during audit proceeding, they say that please make the payment under section 74. They say pay tax, interest and 15% penalty. If you do that, then my credit will be disputable. But if the proceedings are closed under section 73, then credit can be easily availed. No issues. I think with this, now canteen services by factory under obligation of ITC law and part recovery by employees. See, ITC, Dhiraji, see, if I am obligated, there is an obligation under the Factories Act to provide canteen to the employees. So it is obligatory for me to provide the canteen services, hence ITC is available. I'm covered under section, I'm not hit by section 17.5 restriction. The only issue is that if you recover certain amount from the employees, that recovery attack results into a GST. If you recover certain amount from the employee, then on that recovery, there is a 5% GST, and that 5% comes with a condition. Under the rate notification, there is a condition that ITC is not available. Hence, because of the rate condition, I get hit by the ITC eligibility. Alternatively, relying upon certain advanced holdings of Tata Motor, etc., you can take a stand that ITC recovery from the employees is not chargeable to GST, and I should take proportionate credit to the amount borne by the taxpayer. That stand can be taken, but as we discussed during the presentation, the ruling does not lay down the correct proposition. Recovery from employees, it's still a supply for a consideration. My output should be 5% GST, and that rate notification comes with a condition that ITC is not available. So effectively, if you don't recover anything and it is obligatory under the Factories Act, full credit available. But if you recover something, then the issue arises. Now with this, we end our presentation because it's already 6:08. Thank you, Taxman team. Over to you.
Thank you, speakers, for your outstanding presentation and a clear and concise explanation of the subject matter. We greatly appreciate the effort that you've put into making this session a success. I would also like to extend my gratitude to the participants for their cooperation and contributions. We could not have done it without. Although we have attempted to address all the queries raised during the session, please feel free to send any additional queries in writing to sales@taxman.com. Thank you all again. We look forward to presenting another vital topic to you soon. Until then, take care and have a wonderful time. Thank you.
Thank you, everyone.